Hey everyone, it is Evan here from the Trade Risk on Tuesday, August 6th, here with a midweek market recap video. We're going to cover all of the major markets and the current market environment. So looking at our market technicals dashboard, we can see that we did get a rebound today on Tuesday. All of the major indices up about 1% or greater. However, the 5-day change numbers still looking pretty painful here, about 4 to 5% plus over the past 5 days, pulling back, in this recent uptrend that we've been in for most of 2019. We are below the 10 SMA across all the major indices. We are still holding above the 50 and the 200 SMA right across the board. Now, if we scroll down and take a look at sectors, you can see really what is trying to hold up and what is getting hit the hardest. It is semiconductors on the downside, 9.5% over the past 5 days. XLE close second here, 7%, followed by tech, 6% over the past 5 days. On the upside, we still have utilities, which are inching out just positive results here. We have healthcare and we have biotech, which is pretty spectacular to see biotech, I think, in the top 3, still something that I think we should be keeping in the back of our mind. But that rounds out the top 3, still mostly negative territory. In terms of major markets, it's the VIX, 44% pop here in the 5 days. It did pull back today, of course, but still a nice healthy move there. TLT and gold acting as safety havens in this market turmoil, if you will. So those are the best performing. And on the downside, we have oil 7.7% to the downside. We have China 7% to the downside. We have emerging markets 6% to the downside. So with that, let's take a look here at what's gone on with the charts. This is the S&P 500 weekly time frame. Last week, we had the biggest down week of the year for 2019. It was about 3% for the S&P 500. And we came into this week with follow-through selling, follow-through technical damage to the downside on Monday. It was a pretty sharp down day yesterday for stocks, but we did recover a good amount off of the lows here. And you can see just already what this weekly candle looks like. It's an increased range, just as we saw the VIX rising here. This is making sense because we are seeing ranges pick up here in the market. So we have already got on our hands, it's only been 2 days worth of trading, but we basically have a 60-70 point range in the S&P 500 already, and we are well off of the high, well off of the lows, but still negative by almost 2% here from last Friday's close. So a little bit of mixed results here. Basically, it's telling us that, look, market regime, the market environment has changed characters. Last week was not, in fact, just a one-off kind of quick, abrupt pullback, like a quick shakeout below the prior 4 weeks lows. This is, in fact, meaningful, and we're saying that because we did get that immediate follow through with the VIX continuing to rise. So I do still think that this is this is a spot in a time in the market where we do want to be paying attention to potential turning point. At the very least, even though again we're getting the bounce, we want to be cognizant that the market regime has shifted here, and we should expect at least some choppy or two-way trading, increased ranges for the foreseeable future. Now, looking at levels, 2872, the market really disregarded this altogether, just cut right through it. This is a prior all-time high reference point and some prior inflection points back over the past 2 years that the market has cared about. It did not care about it this time. We are closing back above it. And on the downside below that, 2800, we did not get there. We got close to getting there. In fact, I think overnight futures Monday evening, we were trading 2800. But in regular trading hours, we only got as low as 28.22. We didn't officially get down and test that. And again, we did get the aggressive bounce off of 28.22 from this morning. So when we look here at the S&P 500, we have on our hands a 7% pullback from the all-time highs to yesterday's lows. That is the magnitude of this pullback. Maybe it's done here. Maybe we've seen the extent of it, the worst of it, and maybe the dip buyers are going to step in here. If they do, if that is a scenario going forward, it would be a higher low that they would be attempting to put in here. We had the original where this market really turned around hard back in 2018. This marked the bottom. sub 2400. We basically rallied uncontested until April, May, where we pulled back and put in our first more meaningful higher low around 2738. We broke to new all-time highs. We now are pulling back. And again, if we can essentially hold up above 2,800, we have on our hands that potential higher low that the bulls can hang their hat on, can potentially still keep this longer structure intact. However, if we do start to lose this lows here from this week and we start coming down to 2,800, we have to look at retesting perhaps the May low, the pivot low here around 27.28 would come into our sight, and that would approximately be at about a 10% pullback from all-time highs if we get down here around 27.30. So those are the levels that I'd be paying attention to. Constructive to see 28.72. Let's see if we can fill the gap. If we go to the SPY chart, you can see the gap a little clearer. If we can get above today's highs, we effectively had an inside session here today of trading. That's because yesterday's trading range, Monday's trading range was so wide, and even though today we had a strong snapback of over 1%, it was still an inside session. So if we can get follow through to this bounce here and start filling this gap here, that would be the first constructive sign or the first target, near-term stabilization for the bulls. Otherwise, it's been a heavy volume, a very abrupt breakdown here. And again, I do still think caution is advised here. Be tough to be wanting to chase this too aggressively. If I am playing for a bounce here, which really am not, I would want to be, if I were in that trader's shoes who's playing for a bounce, I just would want to be pretty nimble. If we can get into that gap fill, I think that's logical for tomorrow. If we can come up to, and retest this sort of downtrend line here, that seems reasonable. But given what momentum looks like right now, given the speed magnitude of this move over the past 6-7 trading days, I want to be a little bit more cautious here and respect the fact of all of the volume and urgency on this swift move lower. So that is the S&P 500. That's the way I'm sort of looking at things right now, being pretty cautious, sidelined. Of course, it all depends on your time frame. If you're a day trader, you're loving this. If you're a longer term, swing trader, you may be more just sitting on your hands, kind of watching things unfold, picking your spots a little more closer. And if you're a longer term, maybe 7% pullback hasn't started to phase you. And, that probably makes sense if you're that longer term trader, investor, position trader. So let's get into some other markets now. We'll go to TLT. Actually, no, let's look at some of the other major indices first. We'll look at the IWM here. Remember, this one had its brief, 1 week of attempting to start to outperform and looking like it wanted to firm up and break out, and that all very quickly unraveled. We played for that breakout right in here. We played a couple of different reversals here in the IWM, but the most recent was playing for this breakout, quickly getting stopped out just a couple of days after. And again, hindsight says that was a good stop out. We're back to the lower end of this range, kind of testing the May pivot lows here for IWM, getting down towards that area. So again, this will be a critical spot for the Russell 2000 to hold. If it starts losing this 145 area, then it's going to start really structurally doing more damage here on the longer term weekly charts, and that's going to be problematic for just the integrity of this market from a price action perspective going forward. If we go to the Nasdaq 100, you can see here kind of looking like the S&P 500. We're getting a quick, abrupt pullback off of the highs. We're getting gap downs. We're getting heavy volume. We are still in potential higher low land here if we can put in some type of, higher low above 175 or so and hold above the May pivot. Otherwise, though, it still is pretty caution here as we had the, we have momentum pointing down, high volume coming in, breaking of trend lines, disregarding of support, all of those warning signs kind of stacking up and telling us that things have changed. So that is the market outlook here. I think the key takeaway is don't be in a rush to have to participate again. Build your watch lists. Again, I hate, it's tough speaking broadly across everyone that watches this with different time frames and goals, but don't be in a rush to, have to do things. Let's sort of let the dust settle here and let the market kind of tell us what it wants to do. TLT, as we start to move into some other major markets, is getting a very convincing sort of follow-through week to the upside here. We had this explosive breakout week last week of 3.83%, which is a big move for TLT. We get follow-through this week. It's closing at its highs right now. So, in terms of safety haven, in terms of just that bond exposure, the TLT long end of the curve there is getting assets rotated into it, and it is certainly stretched here. It's a tough chase, but when everything everything else is when VIX is 2025 and markets are selling off, TLT looks pretty good as an alternative. So TLT getting that nice strong continuation, and so is gold. Gold here also traditionally considered a safe haven asset in terms of market turmoil. Getting that follow through week, it broke and closed at new weekly closing highs for 2019. It's continued this March higher. MACD is at new highs. Lots of volume coming in here to the upside. It's extended. It's a tough chase, but once again, when we have that turmoil, gold looks pretty good as an alternative. So that's continuing here for both of these safety haven markets. If we go to silver next, silver here mostly just consolidating, hasn't broken out, hasn't taken the cue here from gold. It's just kind of hanging up in sort of the highs it made 2 weeks ago. Nothing wrong with that, just consolidating through time. It had a good high volume breakout move throughout the course of July, so it's still sort of working that off. Trend is up and bulls still in control here for silver. If we go to commodities next, we go to USO. This is getting slammed here now, down 2.96% this week. It was down pretty abruptly over the past couple of weeks as well. It's trading back to Friday's lows here, and it just overall looks like a pretty good mess right now. I wouldn't know how to trade it. Don't have any real directional bias here to be to the downside, if anything. But gold, USO right now, excuse me, is something that can really kind of go either way. It's pretty messy and choppy, in that short to intermediate term. Natural gas, which we've talked about, and we've liked the prospects of this potentially trying to kind of come in here and put in some type of shorter term, intermediate term bottom. Still waiting to see if that's trying to happen here. It looks, we are getting the MACD positive divergence here. It looks like it wants to try and reclaim this pivot from the June the 20th. So if we can get a little more convincing action above 1830, 1840 right here, I think it is potentially interesting. Again, longer term trends are all pointing down. This would be for the very aggressive, active, nimble traders that can be quick and are able to manage risk appropriately. But I do think natural gas back over 1850 or so could get a nice big a nice pop. Not about big, but a pop back into and rotation back into this range that it's been developing in. So that is the rundown. Lots of action, lots of movement here as we come into August, which historically is, again, a little more seasonally a difficult month for market returns, and we are seeing that VIX, which we didn't talk about today, but let's see where it closed on the day, around 20. Yeah, right at 20 here. It got as high as 25 yesterday. It's closed down around 20 here today, but it's still quite elevated, still suggesting that there's some fear out there and some elevated ranges are here to stay. So that'll be another cue, is if we can start to see the VIX come back down below 16, 17, get back down to more historically normal levels. That would give us a little more confidence to start dipping the toes back in the market as well. But for now, again, let's respect and kind of see how this market unfolds into the end of the week. We have those reversal looking candles right now on a weekly chart for the S&P 500. Come Friday, let's take a look at what this looks like. So that's it for me. Thanks so much as always for tuning in. You can subscribe on our YouTube channel, follow us on the Trade Risk. Have a great rest of your day, and we will see you in the next video update.